Federal Reserve independence may sound like bureaucratic jargon, but it is actually the firewall of America's entire economic credibility system. Its goals are not set by the president, but written into law by Congress to maximize employment and maintain stable prices. In other words, its duty is not to serve the president's re-election, but to protect the credibility of the US dollar. But independence does not mean invulnerability. Each Fed governor serves a 14-year term, with one seat expiring every 2 years. The president cannot dismiss them at will unless there is cause, such as a serious violation of law or misconduct. This was the safety valve built into the Federal Reserve Act of 1913, designed to prevent any president from replacing a central bank that refuses to obey. In 2025, Donald Trump twisted that very valve. He announced the dismissal of Federal Reserve Governor Lisa Cook on allegations of mortgage fraud, an act unprecedented in the Fed's century-long history. The Fed was shaken, markets trembled, and the Supreme Court intervened. This was not just a personnel dispute. It was a direct collision with the very principle of central bank independence. Why the Federal Reserve must be a little disobedient. You might ask, isn't the president the nation's top executive? Why should decisions about interest rates or money printing be constrained by an independent institution? The answer is simple. Power has inertia, and markets have memory. If every president had been able to control monetary policy, the dollar would have turned into a political weapon long ago. In economics, this is called the time inconsistency problem. Nobel laureates Kydland and Prescott pointed this out as early as 1977. Governments are always tempted to use loose money to boost short-term growth and elections. But once markets recognize that pattern, inflation expectations spiral out of control, and it takes higher rates and deeper recessions to squeeze the bubble out. That's why smart institutional designers gave the central bank an immune system to make sure it can hit the brakes when the president wants to floor the gas. The Nixon-Burns lesson. Historically, the US has already walked the path of a subservient central bank. In the 1970s, President Nixon appointed his friend Arthur Burns as Fed chair and pressured him to loosen up the economy before the election. The short-term boom helped Nixon win re-election, but the cost was soaring inflation and a devalued dollar. It took 2 recessions over the next decade to bring prices back under control. Since then, central bank independence has been a bipartisan creed in America. International comparison, the Turkish example. Globally, Turkey offers a cautionary tale. President Erdoğan insisted on the bizarre idea that cutting rates would tame inflation and repeatedly fired central bank chiefs who disagreed. The result? The lira collapsed and prices skyrocketed. Ordinary Turks saw their savings evaporate overnight. Thus, the Fed's independence is not just a technical matter. It's a safety lock against the short-termism of political power, an engineering of anti-short-termism. The Fed's architecture is an engineering project designed to resist short-term bias. 7 governors serve staggered 14-year terms so no president can dominate. 12 regional presidents rotate voting seats, injecting local perspectives and limiting capture. The for cause clause ensures a governor can only be removed for serious misconduct. All these rules serve one purpose: to make monetary policy answer to the dollar's future, not the election's present. That's why the Fed must be a little disobedient. Otherwise, a compliant Fed may make a president's term easier. But the next president, and everyone holding dollars, will pay the price. Why Trump keeps intervening in the Fed? Over the past few years, Donald Trump's personnel war against the Federal Reserve has hardly paused. Starting in 2018, he publicly berated Jerome Powell for being too slow to cut rates. Then in 2025, he took the unprecedented step of firing Governor Lisa Cook, citing mortgage fraud. The question is, why is he in such a hurry? In truth, what Trump wants is not just a rate cut, but control of the steering wheel. Short-term economic and electoral goals, making the market soar. In Trump's political calculus, the stock market is votes, and liquidity is public approval. Rate cuts boost stocks, housing, and jobs, and rising numbers before an election make the best campaign ads. Meanwhile, America's debt servicing costs are surging. In 2025, Treasury interest payments exceeded $1 trillion. Lower rates would not only stimulate growth, but also ease that fiscal burden. That's why he keeps demanding faster and more aggressive rate cuts. To him, monetary policy isn't an economic lever, it's a political accelerator. Personnel strategy, shifting the Fed's median vote. The Fed's interest rate decisions are made by the 12-member FOMC, Federal Open Market Committee. 7 votes come from the Board of Governors, and 5 rotate among the 12 regional bank presidents. That means whoever controls a majority of those 7 governor votes can effectively tilt the outcome of key policy decisions. In his first term, Trump appointed 2 loyalists, Michelle Bowman and Christopher Waller. Both favor faster rate cuts. Now, by firing Cook and nominating Stephen Moran, he aims to secure a 3rd seat. If successful, the FOMC's median preference would shift toward a looser and more politicized stance. That would mean the Fed's policy reaction function, how it responds to economic shocks, could become check the polls first, inflation later. Regulatory direction, loosening the financial system. Fed governors oversee not only interest rates but also large bank supervision. Trump has repeatedly complained about over-regulation from the Obama era and sought to roll back Dodd-Frank financial oversight. If he can reshape the board into a pro-growth camp this time, it won't stop at rate cuts. Capital requirements and stress tests could also be eased. For markets, that means higher short-term profits but greater systemic risk. For Trump, it's a win-win. Markets soar and economic figures look better, but the real systemic risks are left for the next administration to clean up. The legal battle, redrawing the line with the unitary executive. Beyond personnel, Trump's deeper ambition is to change the rules of the game itself. In recent years, the Supreme Court has shown less tolerance for independent agencies. In the 2020 case, Saylor Law versus CFPB, the court ruled that the president could dismiss the head of the Consumer Financial Protection Bureau on the grounds of the unitary executive power doctrine. The Cook case rides this same judicial current. Trump is trying to convince the court that he has broader dismissal powers, even over quasi-independent bodies like the Fed. If this logic takes hold, the Fed's independence would cease to be a legal guarantee and become a matter of political grace. This is Trump's multi-front campaign. Replace people with one hand, rewrite the rules with the other. He doesn't just want lower rates, he wants a central bank that obeys the president. And that is exactly the nightmare the system's founders sought to prevent. The Lisa Cook case, a turning point moment. Event recap, a sudden dismissal storm. In August 2025, Donald Trump posted on Truth Social, "I have directed the dismissal of Federal Reserve Governor Lisa Cook for mortgage fraud." Those 30 words sent shockwaves through Wall Street. Cook, appointed by President Biden in 2022, has a 14-year term as a Fed governor. An economist and Georgia Tech professor, she is the first black woman ever to serve on the Board of Governors. By law, a governor may be removed only for cause, serious misconduct or malfeasance. The alleged mortgage fraud was merely a dispute over a home loan form, unrelated to her time in office. In other words, it looked less like an ethics probe and more like the opening move of a political purge, creating a pretext from mortgage dispute to criminal probe. In Trump's narrative, mortgage fraud became a universal key. He and Bill Pulte, head of the Federal Housing Finance Agency and a loyal disciple, launched a two-front offensive in media and law enforcement. They alleged that Cook misrepresented information on a mortgage application before joining the Fed. At the same time, the Justice Department announced a criminal investigation into Cook, reportedly based on a referral from Pulte's office. Strangely, Trump had used the same accusation before against New York Attorney General Letitia James, who is prosecuting him for real estate fraud, and against California Senator Adam Schiff. In other words, it was a political template. Anyone who stood in his way could be labeled a mortgage fraudster. Double standards. Who really deserves scrutiny? When CNBC host Andrew Ross Sorkin asked Pulte, "Will you also look into Texas AG Ken Paxton, who listed 3 homes as his primary residence?" Pulte immediately hemmed and hawed. Unless it's public through lawyers, I won't comment." In fact, ProPublica revealed that at least 3 members of Trump's cabinet had also listed multiple properties as their primary residences. So this was not a neutral legal action, but a selective political hunt. Mortgage fraud was a cover. The real target was Cook's vote on the FOMC. Supreme Court intervention, the ultimate test of independence. Facing pressure, Cook refused to resign and filed suit. Both the District Court and the D.C. Circuit Court of Appeals ruled that the president has no unilateral authority to define what counts as for cause. The Supreme Court then intervened but declined to enforce the dismissal order immediately, scheduling oral arguments for January 2026. It will be the first time in U.S. history that the Supreme Court directly considers whether a president can fire a Federal Reserve governor. The decision will not only determine Cook's fate, but also redraw the future boundaries of central bank independence. Why this is a turning point event. The Cook case is more than a personnel crisis. It's a stress test for the system. If the court upholds Trump's action, a president could replace governors under the mere pretext of an investigation or suspicion. The Fed's 14-year term structure would lose its substance, and its independence would shift from a legal right to a political privilege. But if the court reaffirms a narrow definition of for cause, it will mark a judicial counterattack against the erosion of checks and balances. Either way, this is a constitutional watershed unseen in a century. This is not just Lisa Cook's lawsuit. It's America asking itself a larger question. Who can fire the central bank? If that answer changes, so too will the meaning of the US dollar. The 2 timelines of consequence. Timeline A. Power returns to the White House. Imagine the coming year. The Supreme Court rules that the president may remove a Fed governor for alleged misconduct, thus firing a Federal Reserve governor. Trump immediately fills the vacancy, nominating a slate of loyalist economists whose mantra is, "America needs growth, not patience." From that moment, the Federal Reserve ceases to be an independent institution and becomes the co-pilot of presidential fiscal policy. The newly aligned board swiftly votes for a 100 basis point rate cut. Stocks surge, the Dow hits record highs. Treasury interest expenses fall, and election polls rebound. The White House press secretary declares, "Market confidence is back. America is great again." Yet inflation expectations begin to rise. The dollar index weakens. Foreign investors pull money from treasuries, and long-term yields rise instead. The market is now pricing in a new risk, that monetary policy is no longer independent. A year later, inflation resurfaces. When the Fed tries to tighten again, it finds its credibility gone. Capital markets start assigning a political premium to the dollar, just as they did with Turkey or Argentina. Trump wins short-term prosperity, but teaches markets to doubt the central bank. Power is reclaimed, but credibility is lost. Timeline B, the system holds the line. In another timeline, the Supreme Court rules that for cause applies only to serious misconduct in office. Cook remains, and the Fed's firewall holds. Markets wobble briefly, then stabilize. Investors realize, no matter who sits in the Oval Office, dollar policy still has rules and limits. Powell and the board continue to act by data, cutting rates gradually as inflation eases, lower but steadier. It's not perfect for the White House, but for America's long-term credit and global standing, it's a necessary act of restraint. In this world, the government may endure another year of high-rate pain, but the dollar's anchor remains intact. Epilogue: the cost and the value of institutions. The purpose of institutions has never been to make power convenient, but to make power have boundaries. Once that boundary is redrawn, today's victory may become tomorrow's hazard. Thus, the real question in this case is not whether Cook stays, but rather whether America can still have a central bank that dares to say no to the president. Observation list: 3 signals to watch. 1. The Supreme Court's ruling, the last gate of central bank independence. First, watch the Supreme Court. In January 2026, the court will hold oral arguments on whether the president has the authority to dismiss a Federal Reserve governor. If the court sides with Trump, it won't just determine Lisa Cook's fate, it will redefine the constitutional balance of power. Fed independence would no longer be protected by law, but by whoever occupies the Oval Office. If, however, the court upholds a strict definition of for cause, America's institutional firewall will be repaired once more. 2. The turnover of the board. Who decides the Fed's median vote? Second, watch the people. Of the Fed's 7 board seats, 2 will expire naturally in 2026 and 2028. Who fills those seats will determine the direction of interest rates, regulatory standards, and how the U.S. balances debt with inflation. Every new governor can reshape the FOMC's median vote, just like moving the weight on a balance scale. 3N, the drift of policy signals. What they say and how they vote. Third, watch the votes and the words. Pay attention to speeches and voting patterns by Governors Bowman and Waller. If they start calling publicly for aggressive rate cuts or regulatory easing, it signals political influence seeping in. Conversely, if diversity of opinion remains strong, it means the institution is still self-correcting. The Federal Reserve isn't a building, it's a collective consensus. Once that consensus fractures, even the strongest structure becomes an empty shell. The independence of the Federal Reserve has never been a given. It's something continuously earned and defended. Every president and every crisis tests this invisible line of defense. Trump has merely brought that test sooner and made it sharper. So the next time you hear about rate cuts or monetary stimulus, don't just think of market ups and downs. Think about who's pressing the gas and who still dares to hit the brakes.